What is a junior mortgage? A junior mortgage, also known as a junior lien or second mortgage, is a subordinate loan taken on a property that already has a primary mortgage. It may also be a third or fourth mortgage, depending on the loan structure. In case of default, the first mortgage is repaid before any junior mortgage. This additional loan uses the property as collateral, allowing homeowners to access funds even if their first mortgage is still being paid. Junior mortgages are often used for debt repayment, home renovations, or avoiding costly private mortgage insurance, PMI, through piggyback loans, since junior mortgages are riskier for lenders due to their lower repayment priority. They typically have higher interest rates than first mortgages. However, they offer benefits such as lower interest rates than unsecured debt, potential tax deductions, and the ability to borrow larger amounts based on home equity. There are different types of junior mortgages. Piggyback loans, used to avoid PMI by splitting a mortgage into primary and secondary loans. Home equity loans, HELs, provide a lump sum with fixed repayments. Home equity lines of credit, HELOCs, offer a revolving credit line with flexible withdrawals and variable rates.
Right now, Kalkine is offering a 7-day free trial on its premium research reports. Get access to data-driven market insights combined with an in-depth analysis on financial markets across the globe. Don't miss it. Subscribe for the free trial now.
The process of obtaining a junior mortgage involves evaluating home equity, gathering financial documents, comparing lenders, applying for the loan, reviewing terms, and providing necessary underwriting documentation. To qualify, borrowers generally need a credit score of at least 620 and sufficient home equity, with loans typically capped at 85% of the borrower's equity. While junior mortgages offer significant borrowing power at lower rates than personal loans or credit cards, they come with risks. Borrowers must use their home as collateral, which means failure to repay could lead to foreclosure. Additionally, junior mortgage rates are slightly higher than first mortgage rates, and borrowers must cover fees such as appraisals and origination costs. For more related videos, please subscribe to the channel and click the bell icon to get notifications.